Hello, everyone. I hope you all are having a good time. Welcome back once again to the main stage for yet another smashing discussion. So, yeah, for this VC keynote roundtable, guys, we have Linus Dahg, partner at Inventure, who will also be moderating the discussion. We have Ilsoe, who's partner at NGP Capital, and we also have Jerome, who's partner at Expon Capital. So without any further ado, I'll hand it over to you, Linus. And
thank you so much. Thank you so much. And thanks for inviting us to be part of this. It's hopefully going to be a session where we uncover quite a bit about some of the stuff under the covers, a little bit deeper into what happens in venture funds and in within the partnerships, how decisions are being made, etc. To make sure that you in the audience hopefully get some really good nuggets to take home. If you're ever going to raise venture funding. Exactly, hopefully. But let's start with Bo. Do you want to tell the audience a little bit more about yourself?
Sure, thanks, Linus and Sumi and gang. Thanks for arranging this. So my name is Bo Ilsoe. I'm originally from Denmark. I left Denmark in the early 90s and has since then lived in various parts of the world. I have been in the technology business all my life. First building networks, and then since 2002 I've been in venture capital. I started in London for a firm called Vertex, and then in 2008 started building up NGP Capital to what we are today, a global firm with about $1 billion committed over the years.
Cool. Jérôme, do you want to keep on going?
Yeah. So I'm one of the 4 founding partners of Expon Capital, and so we're based in Luxembourg, and so I've had a passion for tech since my early childhood, basically tinkering with the first electronic gadgets back in the 80s and the first personal computers. Started coding age 12, started investing at 18, and merged the 2 passions in 92. I started using the internet back then. So before the web, I invested a lot in hardware like flash memory, leader M systems, invested in communication, tech equipment, DWDM, satellite, data cars, TV post-production, co-founded a few companies in internet and telecoms, helped set up a 3G mobile operator that we sold to Orange. And I love founders that have deep insights and build truly unique solutions. So where there's literally no competition, with huge benefit for clients. So these days I look at a lot of digital health, energy, climate, and then keep an eye on French science because I'm a bit of a nerd. And so if you want to put a sticker on my head and label me, I'm an entrepreneur, an investor in B2B tech, mostly deep tech.
Gotcha. Cool. And I'll try to do a quick intro myself as well, just so you know who I am as well. I'm one of the 5 partners at Inventure, and we're a Nordics and Baltics focused seed fund. Been in venture capital now for a little over 8 years, which feels like an eternity, but at the same time, I'm still not sure whether I'm a good enough investor or not. It usually says that it takes about 10 years to figure that out. So 2 years to go, then maybe. Other than that, based in Stockholm in Sweden, and I've been living in a few different places as well. So London, Copenhagen, in China, and in Australia as well. But without further ado, let's jump into some of the areas and topics we're going to uncover. Just for context initially, I think it would be good to just get a sense a little bit more about your funds that you represent. So people, if they are considering raising money and so on, they know a little bit what you're looking for, geo-wise, stage-wise, etc. Do you want to go first, Bo?
Yeah, thanks. Linus can do a quick run through. So there is a lot more information on ngpcap.com, our website. Essentially, we are a Series B and later stage investor. We like to have product market fit, and we like to have entrepreneurs that have a somewhat global ambition. Our model is to then help them scale, and preferably also companies with a certain amount of technology content as well. We typically invest 8 to 10 million when we enter into the business, and then obviously with a team in Beijing and with a team in San Francisco, 14 investment professionals spread across three regions, we like to work with our companies and help them also to expand, whether it's being customers, partners, channels, etc., etc. Currently investing from our latest $350 million fund, which was raised in 2017. We have one single LP, which is Nokia. So we also often helping our companies to build relationships or partnerships with Nokia, but we are a financially driven investor as well, and the GP is owned by the investing partners, and we make our own decisions. So it's what we believe is sort of a best of both worlds model.
Gotcha. Cool. Jerome, do you want to go next?
Yeah, sure. So we were 7 team members, and we managed 2 funds, around $90 million. So that's 75 million euros. Our global fund invests in unicorn potential companies, so global leaders, addressing the United Nations SDGs, so Sustainable Development Goals. We don't do sectors because of what I just said before. If we were to do sectors, then it would just narrow down the realm of the universe of possibilities for us. We do investments that matter, so that have a higher purpose. And we cover Europe, the US, and Israel, and then we deploy from 500,000 euros to 1 million as initial ticket for pre-Series A, and from 2 to 3 million euros all the way to 5 million plus in firms generating in excess of 2 to 3 million in revenues. We also manage a fund focused on the Luxembourg startup ecosystem because that's where we're based. And here our tickets start at 150,000 euros and all the way up to 1 million as first investments. And the requirement is for firms to set up their operations there than in our country. So it's typically fintech space, heavy industry, so where our country is shining and where it's a European leader. Yeah, and our value added very much depends on each founding team and their maturity of their business. So we can help with strategy, hiring, fundraising, client introductions. I mean, very much depends on the needs.
Gotcha. Thank you. And just quick on ourselves, Inventure, as mentioned earlier as well, we're primarily focused on Nordics and Baltics, early stage, so tend to be sort of seed rounds and smaller A rounds. So ticket-wise, is somewhere between 500K and 3 million usually. Our goal is to be the sort of the first choice VC in the Nordics and Baltics. That's what we're trying to achieve on every day. And we have, I think in terms of value add, we have 2 people full-time that only works with our portfolio companies, and especially in the 2 areas of expansion and sales and more related around talent management, hiring, recruitment, etc. But that's probably the short version. Let's dig into, I mean, I think one of the topics that you can't really avoid these days is obviously COVID. So how COVID has changed. I mean, I'm sure there's a bunch of entrepreneurs out there that are trying to raise money, and then COVID came and changed everything. How has that changed how you make decisions? How you know, has it changed what you invest in and so on? Would love to hear your views on that. Do you want to go first, Jerome?
Yeah, sure. I mean, it's not much. Would be the first answer. At the same time, we've clearly raised the bar, and we're much more cautious with businesses with no proven traction. Or let's say a weak proven traction, weak traction. To put it more simply. So if you can seize this opportunity as a founder and collect cash from clients now, I mean, you probably know what you're doing. You're doing something right. If not, well, you know what the answer is. So we also prefer recurring revenues over, you know, one-offs type business models. We tend to go towards, you know, software heavy bite tech businesses as opposed to businesses that involve some form of logistics. So in terms of process, we're, you know, obviously not traveling as much as we did, and that means So we're meeting the teams less in person than before. That bothers us to be clear, because we're social creatures, right? And this is a people's business above all. So it's a new way of doing things. Now, as regards verticals, we've been looking at digital health for many years already, and clearly this crisis is a catalyst. Now, this area has probably become a little bit too crowded too, so we're quite careful about that.
Gotcha. By the way, I think there's something, at least I can't see you anymore, Jérôme. If there's something wrong with the camera or something, just FYI.
With the camera?
Yes, we can't see you. It's just a gray screen, or at least I can't see. Can you see him, Bo?
No.
No. Good. Then
okay.
So there seems to be something, either with the connection or with the camera. Just FYI. Bo, is there something you wanna jump onto as well?
Yeah, of course. This has, of course, taken over the public conscious in the most part of this year. So we have about 45 portfolio companies spread between China, US, and Europe. So obviously, first order was to figure out what's going on, who is sort of hit more, who is maybe not hit so much, and who is accelerating. And obviously, as we all know, that we are not the only people at the table. So not only did we have to work with the entrepreneurs, we also had to work with co-investors and very, very quickly assess the situation. And I think if we look at where we are today, if you have sort of told us in April that we will hand you this, we would happily have taken it. We have quite a broad portfolio, so we have stuff which is purely digital, which obviously have been doing much better. We have stuff in enterprise SaaS that have had, to a certain extent, some softness, but on the other hand, also have had some shown the resilience of a SaaS model. And then we have had some stuff which has a strong offline element. If you think of Lime scooters or Get Your Guide, I know Tao is coming on later to talk about Get Your Guide, obviously doing tours and attractions in famous destinations around the world, was not terribly busy. So there was really sort of a spectrum across with our portfolio. And I would say it was probably split for us, 1/3, 1/3, 1/3 in each bucket. But obviously, as you head into sort of a highly uncertain situation, you really need to think about what you do. Personally, I think you can destroy a lot of value very quickly if you cut too fast. On the other hand, if you become a boiling frog and you're not doing something quickly enough, you also will waste a lot of the company's resources. So there was a sort of tough balancing act to do during, I would say, most of March and April to sort of land this in the best possible way. I think that was on portfolio. Then with regards to new investments, we actually we have a company. I'm now in Switzerland. We have a company, Scandit, here in Zurich. We closed a $70 million round that was announced in I believe in May. Obviously, that round was sort of in full action as COVID hit, and we were very happy with the outcome of that round. And the new investor, G2VP from the Bay Area, they were sort of consistent and stuck to their words and the term sheet they had put down. So that was great to see that sort of closing. We did a number of other financings as well. And then we have announced lately an investment in Coda in the US and one in Observe.ai also in the US. New companies were brought onto the portfolio. But I think, as to Jerome's point, it's hard when you cannot meet entrepreneurs. And with a model that we have, we also have a like, for instance, in Europe, we invest across most of Western Europe, and there we of course have a lot of complications of meeting people. We also invest in Israel, and at the moment I cannot travel to Israel. We had in Q2 we also had a large exit. Intel bought Move It where we were a lead investor in one of the earlier rounds, and Intel actually never physically met the company, but closed the transaction. Intel was an investor, I should say, and Intel has a large presence in Tel Aviv. So there was an existing relationship that enabled them to actually complete the transaction. So quite a wide range of happenings throughout Q2, I would say, but overall we're happy where we are at. But we know, of course, it's harder when you cannot meet entrepreneurs. That's just how it is.
Yeah.
Bo, Linus, sorry, can I ask a question to Bo? So given that you're really focused on later stage, when were you done with, let's say, just dealing with the portfolio impact of COVID, and you could move on?
Well, I think we're still dealing with it, right? But
but let's say the urgency of, as you say, not being a boiling frog.
Yeah. I think it took the Q2 basically to get through. Yeah. And that was
and with 50 companies in the portfolio.
Yeah. And that was it was a mix of financings, of restructurings. As you know, in Germany there's the Kurzarbeit, for instance, and these furlough rules, and so it was really a mix with all companies. But also we are fortunate. I mean, given we are later stage, typically also there are more investors around the table, and also the management like Tao, you will see later, for instance, Johannes and Tao are just great leaders, and I think we really took charge and showed a great ability to sort of maneuver through the crisis. I think overall it actually went, also with co-investors, I think it went better maybe than what one could have feared at the outset.
I agree. Yeah, totally. I agree.
Totally. No, I think across the board it seems like obviously VCs had to adapt to just like any school system or any healthcare providers, where it's almost like we moved ourselves a little bit into the future where we can make decisions without really having met companies, for example, or met founders, haven't built that relationship, physically. Like we joked about before we got on stage, it's very hard to do beer tests over Zoom. So I think there's something there where now I think as VCs, we've more adapted to the new reality as well. And everyone I talk to are open for business. It might be that they're looking a little bit different on new types of deals, in the sense that it might be first, maybe at least what we saw was the companies that obviously had a big were hit pretty badly, like in tourism, hospitality, etc., were probably the roughest areas in the beginning. Then you start seeing the ones that really took off because of COVID. We all have some of those portfolio companies as well, especially maybe in the food delivery space. You have the same in healthcare, obviously. You have the same in edtech. So a couple of those really took off. But then I think the wave after that was also that we started to look at, okay, how much of this is just inflated because of COVID? So you started to first see the drop down, then you saw the pickups, and then you try to figure out what's the new normal, which is not like an easy task to do, but I think it's something that most people I've talked to and ourselves for sure have been thinking about a lot.
Yeah, and I think, on our side as well, we're also doubling down our investment in analytics and data. Right now, we have a system that is real-time monitoring 700,000 companies, right? And we sort of continue to enhance that for deal flow and monitoring and market analysis. That helps a lot, and that's something we will do more on. And then obviously we also as VCs need to come a little bit out of the jungle, right? And there's a world out there which is more data driven and driven by software, and I think that's just what we need to do. At the end of the day, we are a people business, so we have to learn to now work within these new constraints.
Okay. Cool. Let's jump to the next question. I think obviously we'll everything sometimes with VCs can feel like it's sort of like this black box. People don't really understand how decisions are being made within partnerships. Like what is how if a company comes to you and you start to like it and so on, how does it go from that initial kind of phase from the introduction to an actual decision is being made on, let's put money into this company? Would love to hear some insights on that, is how you guys work on that. Should we start with Bo this time?
Yeah, I mean, we have particular challenges, so to speak. We are sort of a geographically disparate team. We meet Chinese entrepreneurs that, they speak Chinese, and one of our team members is translating what they're saying, which we believe that's part of our model is to be able to learn across the globe. However, it does create these kind of challenges. And then there is, I think, like other VCs, there is sort of a funnel of companies that are sort of dropping down, and you spend more and more time getting more and more in depth with them. What we try to do is always be very clear on the process. We want to do a quick no if we don't believe that this is really for us for whatever reason it is. And we want to keep the entrepreneur really abreast on where we are in our process so that they are clear. It's obviously always there is some sausage making going on at the same time, right? You're trying to get your market information, your background references, etc. So, but I think clarity in communication is what we strive at with the entrepreneurs, so they know where they're at now. How there's always a difference between what you say and what the recipient hear.
Sure.
So we cannot always be sure that it is understood the way we thought we said it, but I think that's the most important thing, and we don't want to waste the time of the entrepreneurs, right? And we don't want to waste our own time either. So that's how we try to do it, and then really sort of run it through our funnel as swiftly as we can.
Is it partner led? So you need, let's say, a unanimous decision on when you make an investment, or can it be do you do hands up in the air kind of voting, or how does that work?
Yeah, that's a good question, Linus, and we could spend the whole time just debating decision making here, but we have ended up with a voting system. We've spent a lot of time tinkering with it. Each partner votes. You can vote between 1 and 5. You cannot vote 3. A 1 is a veto, and then the rest is sort of it rolls from there. Obviously, when you arrive at the real voting situation, you don't want to get a veto because it means everybody has wasted time, right? So a veto essentially shouldn't be used. It should sort of come early in the process if there is somebody who's really not supporting the deal. But other than that, it's a voting system, and you cannot vote 3.
Gotcha. Very cool. And Jérôme, we'll jump into you as well. And one thing I would love to hear your views on as well, on top of what we talked with Bo, is sort of how you work with your junior people, how they sort of feed into the decision-making junior investment professionals, but that are non-partners in essence. How do you work with them as well? If they don't have a voting, if there's not, let's say, a specific voting system.
Yeah, we're a small team, so we tend to work all together. But obviously, I mean, as a junior, you have more weight, and you don't actually have a vote, but you get to share your opinion. And we don't use the votes, or I mean, we're just the 4 partners, and we have a very lively debate, which I tend to define as absolutely brutal. Because we really, I mean, whenever one of us is presenting a deal, I know for sure the 3 others are going to shake the tree as hard as they can to make sure it's going to stand. And we're very fortunate to be 4 very, very different people. And our 2 juniors, Owen and Lily, are from very different cultural backgrounds and educational backgrounds as well. So they feed into this very different way of thinking. So we're always surprised, and there's always things, the blind spots that even though we by the way, we work in tandem. So there's a partner buddy, and a teammate from there's 1 junior. So it's a team of 3. But there's always something that we missed, and even the fact that we're 3. So it's super interesting, and it does happen that we have to, even after the first committee, we have to go back to the team and say, hey, look, we haven't covered this part, and we need to do this, but that's typically done in a very fast way. So we try to build a consensus as much as we can. Now, how do you define consensus? What is consensus? It's typically going to be very different from one firm to another. In our firm, it's really is everyone on board? Like voting with their feet, or at the very least, do my partners trust me with what I'm doing if they don't really understand what we're trying to do here? And I mean, since we're so different and we're coming with very different investment experience and entrepreneurial experience, we're going to have insights into businesses that are difficult to share because they've been built over a period of 20 to 30 years, right? And even though you can work on the communication, it's the depth of this knowledge accumulated for over decades. There's no way you can hack, let's say, the transmission of that data in a very effective way. So the only way you have to bridge the gap is through trust, right? So either you can build that trust and then it works fine and we can move on and close the deal, or we can't, and that has happened in the past. But that's life. That's part of the partnership.
I don't know. Makes total sense. I think we've never had to go to a formal vote every in our partnership ever. And also in the way that we do it is coming back to a couple of the pointers we've talked about. We don't, everyone from our operation side to our, CFO and so on, we all sort of pitch in during all the meetings. And it's more about, so it's like this soft consensus in that sense, where it's not like a hard voting system, even though it's almost like there are some different philosophies of this, whether you want full consensus or if you want more disagreement and even higher conviction by specific individuals.
Yeah, I just want to say something about that, because I do think even though, let's say it's just between the partners, again, partners are very different also in personality, and we do the voting blindly. So after the case has been presented, each partner will submit their vote and to the CFO, who then collects everything. The challenge with consensus is that some people tend to speak more than other people.
Yeah.
Some people tend to speak first, and when they speak first, they color the view on the following speakers. So there's I think, and okay, I'm from Denmark, which may be a little bit less consensus driven, but I appreciate the consensus driven culture on one hand. On the other hand, it has a lot of traps and pitfalls that are not always apparent. But I think I don't think that there is a perfect way of doing things. I think either method has drawbacks. What we found with the voting is the voting also draws out other views and can actually also then create another conversation or another level of conversation. So there are definitely I think there are pros and cons in these methods, but taking into account these sort of also personality types, we found that voting actually worked better for us.
I like what you said about the fact that, with the voting takes, let's say the fact that there's no first person or last person that gets to say something, which is, as you say, structurally it's a bias, but there's nothing you can do against that. There's no way around it, except by just, taking that whole process out.
You take out a huge part of psychology, right? Like the whole anchoring element of if you speak first, you can start changing the tone of how something is being perceived by the others. It's an important point. Very cool. Let's jump on and we have some questions from the audience. We can start with one of them before we dig into some of the other ones that we have prepped. So first one here is, what do investors think when they are approached on LinkedIn by founders looking for investment? What are your thoughts on it?
Introductions are always better.
Yep.
Yeah. Introductions, warm introductions, can be extremely powerful. For sure. I don't think, I mean, the quick question, did any one of us make any investments following a LinkedIn request? I haven't.
Good question. I find that if it's just a connection, then it's very hard to sort of segment out, because usually any VC that I know will probably have at least a couple of hundreds of people requesting to follow you that you've never accepted. And it just becomes this sort of, how do you signal out, signal from noise? So if you want to do it on LinkedIn, then you have to send a message. So it's clear on what it is that you want. I've responded to a few of those where they've written like, hey, can I send this thing over to you? And they sort of tell me a little bit about what it is. Then that works. But I think it's more the LinkedIn, even albeit not being the best network to control these days, is still where you try to connect with people that you already know or have met. So just adding people for the sake of it doesn't make much sense. So I could definitely get pitched on there, but I will move it straight away to my email.
Yeah, exactly, and that's what we ask, and we get those almost every day. And I mean, that's fine if there's no other way, but we would encourage you to do what Bo suggests, which is to get a warm intro.
Yeah, and the other thing for us is investing at a slightly later stage is that all the interesting deals are already being pursued by VCs, and most deals we do are competitive, right? It's a long time ago we didn't do a deal that wasn't competitive, which means that as a VC, you actually need to go out and throw yourself into the fight, right, to get into the deal. We did for a while structured what we had from inbound, either through our general email or through other channels, and we have never done a case in those. And this is not that these are bad people, but it just doesn't happen.
Yeah. We have, actually. We did one last year, a seed deal. We had an intern that sort of was tracking everything on our website and our info kind of general email, and found a deal she thought was interesting, and she'd been with us a few months, and then met with them, had a call with them, involved 2 other people, and I think 5 or 6 weeks later we had closed that seed round. So it can happen, but it's rare.
And in my dose, I mean, you do the earlier stage investing, so it's a different dynamic.
And it's also a way of, the way that I see it is also, it's a way of, the warm introduction is always the easiest and obviously the best, because then you kind of you all automatically will put it up on top of your to-do list. But at the same time, it also sometimes means that if you don't have that network, or the founders don't have that network, obviously they will have to fight a little bit harder to get that intro, or have to stand out at a cold email or a LinkedIn message or whatever it might be.
I want to second that, Linus, and just to send that message out, which is that for us it's around 10%, roughly 10% of the deals we've made were deals that we either found by people in the conference or people reaching out. So there is let's say at the seed stage, there is always a possibility, and that's why we keep those channels open. They're important for us because the truth is you never know where the good deal is going to come from.
Yeah, and I think it's to both Bo and Jérôme, your points. I think it's a little bit different depending on stage here, because obviously, Bo, you will probably know most of the companies that could be. You will know in the funnel, like which ones are the ones you should interact with. Whereas for me and Jérôme, who are working a little bit more early stage, we have to be a lot more exploratory on where we get deal flow from. It can be that conference, or it can be this online networking event, which, given that we don't really go to conferences anymore, or it is that LinkedIn message, or that kind of apply for funding on our website kind of thing, even, right? Cool. Let's jump into one of the things that at least I have been talking a lot about recently is sort of, VCs will pass for multiple reasons whenever they meet a company. And the one thing that I find that people rarely talk about is sort of how investors think about how big a company needs to get. So in essence, it's something I sometimes call VC math. Like, how do you do the math on figuring out how big a company needs to be in order to sort of convince you over that you want to make that investment? How are you guys thinking about like the size of the companies? How big do they need to get to sort of attract your attention? Should we go with Jerome this time first?
So we're actually every Monday in a deal flow meeting, one of the things we look at above and beyond what the company is doing is what kind of ambition they have. And if they don't have it as an ambition to reach approximately 100 million euros in revenues within 5 years, then it's probably a no. Let's say there's a gray zone where maybe there's like a year and a half difference, and we may still be investigating that the company anyway. But we need to see that. So we're going to target something like 10x at least, and we need to see the company being able to be valued in excess of 500 million. Otherwise, the math just doesn't work. I mean, we're gonna make some money. We're gonna make 2x, 3x. But honestly, is that gonna return anything for us? No, because we typically are going to. Our deployment strategy is we deploy very little money in the beginning, and we deploy large sums of money from, let's say, Series B onwards. So given this way of deploying the money, it means that we need to look for extremely large outcomes.
Paul?
Yeah, it all depends on the entry price, right?
For sure.
I mean, we have made about 100 investments. More than 10% of our companies have exceeded $1 billion valuation at some point of time in their life. We would like to see a 5 to 10 times return, right? That's why I say we would like to see. Now, of course, not everything gets into that bracket when we invest. To Jerome's point, if you consistently do 3x on all your investments, you're one of the best investors in Europe, right? But I mean, we like to see a 5 to 10 times return, and that drives, of course, a lot of the way we think about it. The other thing is the really big outcomes take longer time to mature. So you will be in longer with the companies that are actually developing well and growing to become really large. And I mean, like Get Your Guide, for instance, we invested first time in 2015, right? We're now with them on the 5th year. I hope we'll be in for another 5 years, right? Because I think they have a long way to go. So that's the other thing you have to think about, that when you are looking at big outcomes, typically they take a long time to mature, right? You see from Sweden, you have Klarna and iSettle, right? That was also a longer journey, right? But now they became very big companies. So I think for us, it's that's sort of those are the things we look at when we enter.
And I think we have, as I think I might have mentioned, we have 120 million euro fund right now that we invest out of. And in order for that to even make sense, we have to look for companies that are roughly sort of at least 500 million kind of enterprise value. And in a good case, we'll own, after multiple rounds, we'll at the best own maybe 10% of that company. And even that then would only yield 50 million back to the fund. So I think a lot of the founders, when they think about how big something needs to get, there's some level of understanding potentially about how venture capital works. So what we have delivered to our LPs is to deliver usually roughly about 3x on the fund. So if we have 120, we're supposed to deliver back 360. And in that 360, if we have one company sold for 500 million, we own 10%, that's 50 million out of total 360 that we need to get back. We need 6 of those in order to even make the fund just go round. So that's something at least I think that founders should think about, or at least know how we're functioning, because it can help sometimes even decipher a bit on why we pass on a company. It usually has to do with we don't believe this can be big enough. So that's good. We have a few more minutes to keep on going, so we can jump into a few more questions here. One thing that I always find is interesting is obviously sort of anti-portfolio, which is the company that you have looked at and said no to, and what are your learnings from now with the luxury of hindsight?
So I can take a stab at that, and I would say we, like many other people, we are looking at price, and I think sometimes we don't understand how big things can become, and we passed on Unity in 2011. It was 180 million pre-money, and we felt that was too rich, and obviously we didn't understand how big it could become. But I would say our thesis about the market sort of held sort of true, that it was a difficult company to exit. It doesn't mean it's not an important company. It doesn't mean that they have not, the Helgeson brothers have not done an amazing job at getting it out there. But so that was one. And then we had a meeting in 2012 with WhatsApp. And they were taking money from Sequoia at 800 million pre, right? And this is 2012, right? So, and even we had tried, we would not have gotten in, right? Sequoia simply kept that company to themselves. But I think there are some cases where you have a hard time figuring out how big can something really become, right?
So, Jerome, any famous?
Well, I'm going to be very arrogant and tell you I don't have time to live with regrets, and which is true. Actually, we just, of course, there's lessons learned, and I think Bo summarized them really well. But other than that, we just carry forward, and we try to focus on what we can do, as opposed to and by the way, there's. As opposed to really having this anti-portfolio, there's things that we would have liked to have done and that we didn't do because we couldn't do them because we saw that they could have a potentially a stellar performance, but they didn't address any UNSDG, and that was an issue for us. But hey, that's our choice. We decided to. For this to be a key criteria for us, and we live with that.
Yeah, I would just, Jerome, I think you're right, and I often in our team, people are sort of like, oh, we missed this and we missed that, and I'm saying like, look, it's good we have a look at these things, and then one of you're going to hit one of them, right? So in that process, obviously you will miss some, and that's the name of the game, right?
Yeah, we've missed some as well. I think the main reason why I think anti-portfolio is interesting is because if there are specific learnings from why you miss something, so it's more on reinforcing why you miss out on something. Is there some sort of blind spot that you might miss because of, let's say, you're not looking at deal flow? Not all deal flow are the same. For example, it might be that something is.
Let's be very clear with the audience. I mean, number one reason is speed, right? And I think the industry knows that. Is we're small teams, all of us. I mean, even the largest of VCs in this world is relatively small, and then we have limited bandwidth, and we have a portfolio to take care of. And so speed is very often the number one reason why we miss deals, right? And that's so.
Yes, cool.
Yeah.
Let's we have a few more minutes to go. So I think just to wrap things up, I think it'd be good to hear some of your high-level best recommendations for founders who are raising money. I mean, it could be anything from, what red flags do you look at and they should avoid, or should you create momentum during a fundraising round, or how should they get in touch in the best way? We touched upon that a little bit, obviously. If you get to give one piece of advice to founders who want to raise venture money, what would that be?
Come super well prepared. I mean, well prepared means that not only a pitch deck, but it's really with the whole sequence of 3-month sequence needs to be well planned with, and building the momentum. You need to have a lot of good news in store. Every time you speak, you have good news. Every time you speak with the investor, you need to bring something new to the table that shows that you're progressing, that things are moving forward. I think this momentum thing is the single most important thing above and beyond the, let's say, the basic foundations of why we invest in the business.
Yeah, I would say be clear, be brief, answer the questions. And if you're not sure you're answering the question, ask whether you're answering the question. But don't answer a question with a 10-minute speech. Answer the question briefly, and then we want to see a lot of energy and passion for what you're doing. And I think if you are one or two founders, have the one who is the best presenter speak, because at the end of the day, it might be a short meeting, and you want to leave the best impression that you can. So those are, I would say, those are the for me, some of the simple things.
Other things I thought about as you were sharing your views is very often and at early stage, founders are very weak in terms of what's the value prop and what are the potential barriers to entry. Why is this unique? And it's all a cohesive package, let's say, because they're all intertwined, all the elements I just mentioned. And they tend to be very rarely crisp, right? Extremely rarely. And that's the reason why we end up not investing. And that's why we end up investing in those that come and have a very crisp package, and they totally understand the ins and outs of their value proposition with the moats and how they can move forward and further increase the let's say their barriers to entry and the value proposition.
I think there's something around the unfair competitive advantage. Why will you as a team stand out in this market with these market forces, building this product, etc.? So even if you don't, as a founder, might have the total unfair competitive advantage, play to your strengths on that you do have that. That will help you in the fundraising process as well. If you can show that you as a team are the right team to build a product in this specific market, solving a solution.
Yeah, I would say to Jerome's point, it's the old saying, I didn't have time to write a short memo, so I wrote a long one. And I'm an engineer by training, and many founders are engineers, and you like to explain how stuff works. Investors are not that interested in that, right? They're interested in why are you going to win this market, and that you're able to articulate that very succinctly.
Very good. I think it's time for us to wrap up as well. Thank you so much for taking the time to participate, and thank you guys for inviting all of us. Sumitra?
Yep. No, I mean, what can I say? I mean, what a phenomenal discussion, guys. Thank you so much, Linus, Bo, and Jerome. I mean, ideally, we don't want you to stop, but the schedule must go on.
Yes.
But just FYI, I mean, while we started the summit, we did a quick poll around which stage your company lies in. So 68% of our founders are pre-seed and seed stage right now. 2% each Series A and 2% each on Series B and beyond, right? So I think all of them must have got a lot of insights, and they should cherish this as they progress on their entrepreneurship journey. So thank you once again. Thank you for sharing those insights and agreeing to be part of this. So yeah, I think there are some questions. We'll like kind of collate them and send it your way. If any of the founders would like to talk to you more. And anyways, we have you for VC Connect sessions as well. So yeah, thank you for this amazing panel, I would say. Thank you.
Thank you so much.